All right, guys, welcome back to another market update. We're going to cover kind of 2023, what we're looking at headed into this new year. So, happy new year if you're watching this in the new year. But once again, Brian Grimes, your real estate mentor, just here to give you guys the information based on the research I've been seeing in the market. I've kind of gotten, as we've been doing these, more and more requests to keep going. So, I just want to kind of keep flowing with these things so that you guys are prepared for what's to come. Sometimes we can kind of get a little bit blindsided by what's going on in the marketplace. And I found it to be increasingly just more and more important to keep your eye on the ball because the market is changing. This is like if you study economics in college or at any level, this is like real life economics class. So you definitely want to pay attention to just the macro trends that are going on. So I want to cover a lot. Make sure you guys like, comment, subscribe. You're watching this on YouTube. Helps with the algorithm. So like, comment, subscribe. And let's just jump right into this. So what are we seeing? We're seeing so much in this market. It's kind of getting nutty. But we'll start with the Fed and we'll kind of work our way through how that's impacting certain areas of what's going on here. So let me just put this on mute. Um, so the Fed, we just had a recent rate hike with the Fed, right? So they just jumped up another 50 basis points. We were jumping up around 75 basis points. So this is already the beginning of what I've been talking about to a degree, which is the Fed is starting their about face. The only way out of a recession, and most of you have heard me say this before, the way out of a recession is to reduce rates. You have to reduce rates to get yourself out of a recession. You can't just keep increasing rates indefinitely. There are some arguments about whether or not we're in a recession now. We're in a recession. I mean, I've seen like the party that's in office now is kind of trying to change the uh, qualification for a recession or how they're measuring a recession. We've been in a recession. We're going to keep going deeper into a recession. And the Fed is just kind of hell bent on keeping inflation low, which makes sense to some degree. It is working. But as you see them reducing the amount of the rate increases, you're going to see we're going to flatline. The projection is that we're going to keep bumping up. We have about another percent, maybe a percent and a quarter of rate increases to go. And then we're projected to flatline and start to do an about face. And we already are seeing a flatlining of inflation, which is good. So inflation is still increasing month over month, but back within historic levels. So what is happening with the Fed increase of the fund rate? It is working in that sense as we're heading into this recession. So what are some of these median Fed fund rate uh, levels that we're supposed to be running ourselves into? Because it's important to know they're not just going to increase rates indefinitely. Right now we're in that 4% range, and the projection is that they want to get us into 2024 and 2025. They want us to be at 4.1%. This is according to the Federal Open Markets Committee, who sets these rates. They want it to be in 2024 at 4.1%, and in 2025 at 3.1%, which means in 2020, the 2023 projection is at 5.25. So rates should peak somewhere in 2023, probably in the middle, May, June, and then start to about face as we get into 2024, where they're projected to reduce rates about 1.25. So 1.25% reduction in 2024, and then focusing on 2025. By the time we get into 2025, they want to reduce rates another point. So getting us down to, in that 3% range. Let me ask to unmute. In that 3% range. So this is really good for my projections, which are you want to get yourself in this game. You want to maybe look into some of these rate buy down strategies or some of these midterm investment strategies where you can create cash flow today and not hurt yourself long term. Get into the market, keep buying because we're going to talk about it. Some of the metrics that I'm seeing. we're already starting to bottom out in some areas, and mortgage activity is picking up in some cases, like right now, which is a indicator that we're bottoming out a little bit. And you don't want to miss this window of opportunity sitting on the sidelines thinking, oh, it's just going to keep going down. It's going to go down more and more and more. And as you sit on the sidelines, you could miss this once in a lifetime buying opportunity. So just know that from the actual Fed, the market committee, they are projecting that in 2024 rates, they're going to cut their rates about a point and a quarter, and then in 2025 another point from there, down to like 3%. Right now the 2023 projection is to get up to 5.25%. So 2 years from them, down back to 3.1% for the Fed funds rate. So as they reduce it, mortgage rates should also be coming down in conjunction with that, right? Because they're going up in conjunction. So we have that hard data that matches the projection that I've been giving to you guys. So you just want to keep an eye on that. Buyers activity is increasing. So after months of declines in the buyers activity, months of declines in the mortgage applications that we've been seeing, the refinance applications, we've just been seeing months and months of declines. Now we're starting to see a slight increase in the activity. Why is that happening? It's probably happening because mortgage rates are going back down again. Mortgage rates have actually fallen out of the last 6 weeks. They've fallen for the 5th week in a row, and 6 out of the last 7 weeks. So rates have ticked down for the 5th week in a row as of December 8th. And for 6 out of the last 7 weeks, rates have gone down. So as rates are going down, the buyer's market is paying attention. They're not completely asleep at the wheel like I thought in some cases, and they're continuing to buy now. We may, in many cases, we may have seen the peak of interest rates on 30-year fixed mortgages. There were some people who were kind of like, I'll call them like fear mongers, who were projecting, oh, rates are going to go up to 10% on 30-year mortgages. Look what happened in the 80s. I didn't quite believe that because I'm still more of a midtermist and thinking about, the long term. Once we get into kind of 2025 and beyond, rates could come back down, to 3% on a 30-year. I don't think they'll get that low. They'll probably get into the 4%, maybe 4.25. But we're already starting to see that activity shift back to the buy side to make it more of a strong buyer's market, which will eat into inventory and then push prices back up, which is why I think this is a once in a lifetime buying opportunity. As prices are falling, you need to stay tapped in. So just know that the mortgage activity is increasing. It's not like increasing to the point where we're about to take lift off here. It's just increasing month over month versus it being just going straight down and kind of decreasing, which is what it's been doing since rates have been going up, as of like March, April, we'll call it. So that's another data point. Let me just put somebody on mute here. That's another data point to concern ourselves with. And mortgage rates are continuing to decrease even though the Fed's continuing to increase rates. So that's also like a divergence, right? So as the Fed, even though they're bumping their rates up less, they're still bumping them up. So as they're moving up, rates are coming down on the 30-year. This is showing you kind of a pressure for rates to come down, right? Like you just have to pay attention to what's right in front of you. So if mortgage rates are coming down while the Fed is bumping rates up still, what's going to happen when the Fed starts to drop their rates? Aren't rates going to come down further? Because there will be even more pressure to the downside. So it's just showing you that pull. The market knows the mortgage industry is not directly tied to the federal funds rate. It's partially tied, but it's still based upon supply and demand. If rates go too high and people just stop buying and the mortgage activity dries up, they have to reduce rates to match the market supply and demand. So you're kind of seeing some of that and just some of the pressure there. So it's very interesting to kind of watch this stuff and just stay tapped in. So we talked about the peak. Let's talk about builder confidence. So I took a look at the builders confidence index to see what are the builders doing? What are the developers doing? The people who are out in the Midwest buying, land lots and just building new developments completely. So they're just buying plots of land, acres and acres, and just tapping in, water lines, sewer lines, and building. What are they doing? And the way to track them is to look at the new permit starts. So whenever they build these round up deals, they have to pull permits. So you can just track that activity. Um, New permit starts are down 30% over the last 8 months. And there are a lot of things that go into that. One of the things is the cost of construction materials has increased, exponentially over the course of time. Lumber's up, electric materials, plumbing materials, all different types of materials are up because of the supply shocks that have largely been COVID related. They could be like Ukraine related in some instances. It really depends. But they've just been kind of global pandemic related. So as those shocks hit, costs go up on builders. And if they go up too high and the mortgage rates go up, because while they are ticking down, they're still double, they're still at 6%, 6.3% instead of 3.2, 3.1%. So builders are feeling that impact of the increased cost of building these properties and carrying that debt load, and then the cost of the materials. They're kind of trying to wait out the market. And the national builders, they have pretty deep pockets, so they can just pause a project for a year and wait it out. The average ground up deal is like an 18-month cycle. So if you're going to go ground up like a 40 unit building or a 50 unit building, you're talking about a 18-month cycle from soup to nuts, from starting with just a plot of dirt, getting the testing done, getting the zoning done, dealing with all the architects and engineers, and getting everything teed up. It's a very long turnaround time. So sometimes you'll just see these projects kind of pause, or people just won't start them at all. So we're seeing a decrease there. In terms of like a confidence index, in January of 2022, the builder's confidence index was at like an 83 out of 100. It's very high. Right now, it's pretty much been going down month over month. This is the 12th consecutive month of drops. And right now, that confidence index is at 31 out of 100. So it's fallen from 83 in January of 22 to December of 22, a 31, which is pretty much a historical low. And one thing that we should note is that the difference between November to December has been the smallest drop. So I believe in November it was like a 34, and now it's in December at 31. That's a smaller drop month over month than has been from the previous like 12 months, dropping from 83. Then the next month is like 65, 67. So we're already seeing potentially a bottoming or kind of a turning around of confidence. If confidence, maybe next month it goes to a 32, that would be the first increase in consumer confidence that we've seen in a year. So it's not always about whether or not some of these indices are going up or down. Sometimes it's a rate between the month over month change, and kind of tracking that to see, are we turning around, at what point of the curve are we, and how can we stay ahead of that? So confidence is at a low, but it may be turning around. We may be bottoming out. I found this to be interesting because there are some people that are interested in this market that are in the VIP course. The Atlanta market, which has kind of made headlines for a variety of reasons. One, the Airbnb debacle, where they're just like banning Airbnb and in Atlanta like as a whole. They've been rated by the National Association of Realtors as the top market to watch in 2023. Apparently, Atlanta checks all of the boxes. There are about 10 boxes that get evaluated. Out of 179 cities in America, Atlanta scored the best in these 10 categories. One is better housing affordability, so just affordable housing. Greater numbers of renters who can afford to buy a median priced home. So about 20% of the renters in Atlanta can actually afford to purchase. They have the income and can afford to purchase a single family home and just pay like a mortgage, which apparently is pretty high for most of our major cities. Most of our major cities in America are what we would call they're almost like little renter nations, where 60 to 80% of the people rent, and they really can't afford to buy. Think about places like California. It's just like a renter's nation out there. Most people can't afford to buy and they're just forced to rent. Stronger job growth. There's a lot of tech companies and different types of companies that are flocking to Atlanta. They have faster growth of the information industry jobs, higher share of the information industry respective to local GDP. They have a lot of migration. A lot of people just want to move there. They have a larger share of workers teleworking, very fast population growth, very good inventory growth, and smaller housing shortages. So they scored the best out of 179 cities. So keep Atlanta on your radar. Atlanta has a lot going for it. When there are jobs and wage growths that are happening in a certain area, you want to keep your eye on it, especially if you're building kind of affordable or workforce housing. You guys know I talk about co-living all the time. And when you're building co-living, you want to be focused on that workforce housing. If you start building workforce housing in places like Atlanta, you're just going to have this insatiable demand and a lot of people moving in, a lot of people making good money. It's just a good recipe for you making good cash flow. So keep your eye on that city. Um, More on the National Association of Realtors. Rents. So, what have rents been doing? This is important because we're cash flow investors. So, we need to pay attention to rent because while rent has been going up, I would say like historically, rents have just been rising kind of all the time. There are some markets in the Midwest right now where rents are projected to fall and have been falling due to supply and demand issues, due to too many hedge funds coming in like the open doors and even Zillows to some degree, just buying properties and putting them up for rent, not really knowing what they're doing, but doing that at scale. And the market pulling back into this recession, and people are just not renting these properties, so they're just fire selling them, dumping them back on the market. And if there are too many in certain areas, if there are too many rentals available, you have to drop your price to compete. So you start to see that, and rents can fall in certain zip codes or municipalities from time to time. But nationally, rents are projected to rise about 5% nationally in 2023, which is good. Good news for buy and hold investors. It means you can bump up your rents. That annual 2%, roll them up, and as long as rents are strong, cash flow investing is like the way to be because you're getting your income, it's covering the mortgage, maybe rates come back down a little bit, and you're just kind of locking in more money for the long term. Rents increased in 2022 by 7%. So rents have been going up. Rents, I believe in like 2021 went up double digits in a lot of areas. So that number in terms of the increase, it is decreasing, most likely because of the recessionary pressure. But just know that rents are still pretty strong. They're increasing. As long as rents are going up with inflation, 2 to 3% nationally every year, that's really all you need. It's going to outpace, the increase in taxes, which is usually like 1% in terms of like property taxes. And, that's kind of all you need. Um, Market activity. What else do we have in terms of market activity? The National Association of Realtors is forecasting that 2023 home sales will dip by 6.8% compared to this year, and that the median home prices will tick up slightly um, to point by 0.3%. So not by much. So the projection is that prices will stay relatively flat in 2023. This can still make it a buyer's market depending on your investment strategy. So if you're buying shells, properties that need heavy gut renovation, prices are likely going to drop substantially in that area because those properties they were getting priced in. There was like a future premium that was being priced into those properties. So a lot of sellers of shells were promoting, or at least the agents were, oh, this property, by the time you're done renovating it, it's going to be worth this. It's going to be worth more than what the market is. So they were factoring in a premium on shells. So people were paying an extra 20, 30,000 for the shell, assuming that these properties were going to appreciate another 30, 40%. And if that happened, they were going to be able to get some money out of that, on the upside. The reality is that's kind of gone. Nobody's buying that story, so nobody's believing that. Oh, if I pay more for this shell, it's going to be worth more in 2024. Chances are it's not unless rates come down substantially. So with that being the case, when you're investing in that type of asset, you're going to do very well because you're going to be able to negotiate against them and say, hey, we don't know what the market's going to do. Even though you think it'll be stable and go up, we don't know what it's going to do. So I just want the best price on this shell. I'm going to lowball you. And there's going to be more and more shells hitting the market because if prices are flat, properties are going to sit on the market longer, inventory picks up, and now there's a ton of shells. So what makes your shell better than this guy's shell? They're sitting on the market 40, 50 days. They're going to take a lowball offer. So know that you can definitely lowball offer people, but prices, if you're sitting on the sideline, more importantly, and you're expecting, oh, the market is just going to collapse and I'm going to swoop in and buy these properties like for dirt cheap, the prices will pull back because this is not a national market. It's a, as we talk about all the time, a micro local market. So in some of these local markets, prices will pull back substantially. In California, in the Midwest, in Arizona, in parts of Florida, we're already seeing prices pull back substantially. In the Northeast, we're not. We're seeing flat prices and then just more of a buyer's market, which is really good for developers and what we do with the BRRRR strategy, because we don't want prices going way down with the BRRRR strategy. If they're flat and we can negotiate harder and buy them cheaper, that's our best bet because we can lock in that developer spread I talk about and make good money. So it's just an interesting take that prices will remain pretty stagnant. Sales will drop. So if sales drop 6-7% because there are less buyers on the market, more properties are sitting on the market. So as sales drop, that means inventory increases. Not that more properties don't come up for sale. So it's a really good equation that is going to forecast a buyer's market, a strong buyer's market in 2023, which is where, I want you guys being ready to buy, getting your pre-qualifications letters together, getting your credit together, getting everything teed up to be in a position to buy. During a recession, foreclosure rates tend to increase, right? So we are, in terms of foreclosures, we're projecting that foreclosures will increase a bit during these recessions. Let me just put you on mute. We'll open up for Q&A really soon. So we are projecting that. Let me just get back to where I was for these foreclosures, because the recessions, they often go hand in hand with like the job layoffs, and as people are losing their jobs, it can just cause them to fall behind on these mortgage payments. One thing to keep in mind is that if you look at the foreclosure data, you may get thrown off a bit because the number of foreclosures is projected to not increase exponentially in terms of like a wave of foreclosures. So there's been a lot of talk about there's going to be a wave of foreclosures, but the data is not going to show it. And why is that going to happen? And this is really important. This might go over somebody's head, but really important to key in on. When people stop taking out mortgages to buy homes, foreclosure rates usually don't go up. They usually go down because every year a lot of new mortgages fall into foreclosure, a large percentage from like just bad underwriting, or you got a property and then life happened and that property falls into foreclosure. So if we have a time period where rates are going up and we know that mortgage applications, while they're kind of balancing out and increasing slightly, they're still at all-time lows from the last, we'll call it at least 5 years, they're at a low. As that happens, foreclosures are naturally going to be suppressed because mortgage activity is lower. There are less new mortgages out. So that foreclosure activity will appear to be suppressed from the data standpoint, but actual foreclosures could be actually very high on these existing properties. These people who've been in these eviction and foreclosure moratoriums that have now kind of ended. There's no COVID relief anymore. There's just no COVID relief at this point. So people are going to be losing their houses. This is a good time to stay tapped into the foreclosure market if you're interested in that and if you're focused on it. The markets with the most foreclosures historically every year are, and this is the rank of the top California typically has about 7,360 foreclosure starts every year or thereabout. Florida has about 6,600. So it's a huge state for foreclosure starts. Texas, 6,200. Illinois, which I'm sure a lot of that is Chicago, 4,700 foreclosure starts. And then New York actually has about 4,000 foreclosure starts every year. So those are the big cities or states: California, Florida, Texas, Illinois, and New York. And you can target some of the cities within those states to find out where more of the foreclosures are happening. So hopefully all of this helps kind of to put a bow on all of this. We're seeing kind of the rate increases start to stabilize a bit. The Fed is not hiking as much. They were doing 75 basis points. Now they're doing 50 basis points. They're projected to increase rates another point and a quarter, another 1.25% heading into 2023. We think they'll be there around kind of the middle of 2023, and then they will start to about face as we get to the end of 2023. In 2024, the projection is that rates will be decreased down to, from the federal funds rate, down to about 4%. And then in 2025 down to about 3%, which means the Fed would start to reduce rates to do that quantitative easing and push more money into the economy to boost us out of this recession that we are in. And as that happens, mortgage rates will fall even further, maybe back down into the 4% or high 3% range. And as that happens, there will be a very small window where pricing is still pretty flat. Lots of buyers are still, their confidence is going to be low because they're not necessarily tracking this data as carefully. And there's going to be a window where it's still a buyer's market, rates have gone down, all of the buyers haven't just jumped back in, because that's not how it happens. It kind of happens gradually over a course of, quarters. We'll call it 2-3 quarters, so 6 to 9 months. And there will be a window to jump in and get some properties, or a property, or your first property, for pennies on the dollar in a nice city, a nice market, maybe Atlanta, because it's projected to be one of the top markets. But Philly's a top 10 market. Baltimore is a top 10 cash flow market. Cleveland's a top 10 cash flow market. Detroit is in the top 10. There are a lot. I'm going to drop a video soon on the top 10 cash flow cities in America, and how to tap in, and who has the most cash flow, and the strongest rents, and who's the best based on some of the metrics that are being tracked. And that'll just kind of be that. So hopefully this helped you guys. That's kind of my take on things and the data going into 2023. Rents are going to be strong, prices are going to be flat. It's a buyer's market. It's just prime time for us. And hopefully the cost of construction goes down a bit. And if that happens for us as well, we're going to be in really good shape as material, and supply shocks just decrease on us. So hopefully this helps. Like, comment, subscribe if you're tapped in on the YouTube channel. We're going to open it up for Q&A. So any questions, let's go ahead and ask, and we'll stick around for the Q&A for as long as possible, and then wrap this thing up. Any questions out there, feel free to drop them in the chat. And if not in the chat, you can hop off mute and ask your question as well. Anything about real estate. Okay. So the question is, how do we target properties in New York that are in foreclosure? So the best way to target properties, you'll hear a lot of this stuff too. And if you kind of YouTube or Google this stuff, you'll hear a variety of different strategies. Some of these strategies, they all work, by the way. So all of these strategies work, but I want to talk about who you want to be and what works best for you. So you first, you list build. If you want to find properties that are in foreclosure, you want to list build. So you want to go on some of the websites like PropStream. You want to pull records. So you can pull records on like properties that have violations on them, properties that have just been sitting on the market and they have work orders on them, or a violation like a trash violation, we're just going to fine you. Those are typically properties that are sitting vacant. And they may not be on a foreclosure list or in foreclosure, but they might end up on the tax sale list. It's just showing you that somebody's not taking care of this property. You have all different types of municipal liens, like if you don't pay your water bill, they'll put a lien on your property and you can end up on an auction to get rid of that lien. So you want to target and list build as big as you can, as many properties, and then you can narrow that list down to properties of interest based upon zoning. Like if you want to go after multifamilies, you'll start to screen it for just multis. So you start to really tap in on what your focus is there. And once you have that list dialed in, you skip trace the list. So you go to different websites, some like PropStream or Deal Machine or some of these other websites, they will do it for you. So it'll just be a click of a button. You push one button, you pay 10 cents per record, 15 cents per record, whatever it is. And they'll give you the person's cell phone number, address, mailing address, email address to a degree. And now you take that information, you can download it as a CSV file, upload it into some software like an auto texter software, and you can start to blast these people. So you just blast them with texts, emails. You can send direct mail campaigns, so flyers and just direct mail, and you chase people down. You're basically blasting out as many messages as possible until the point where you hear back from somebody, and then once you hear back, you will start to try to uncover the lead and see if they're interested, if you can make them a cash offer. That messaging is generally like, hey, I'm looking to buy properties. I'm Brian, I buy properties in New York. I'm a local investor, cash buyer. Just wanted to know if you would be interested in a cash offer. So that's cool. And then you have the other way. So if you've been like me, you've been driving down the street and you just see like a sign on a light post and it's just like, hey, we buy houses. And it's just like a number. And you're like, who's calling that number? Well, somebody's calling it, or people wouldn't put these signs up, right? So it does work. Bandit signs do work. They are illegal in some cities, but if you post enough of them, that game plan is like post 100 of them and put them in major roadways where there's like traffic, which New York it could be good for, right? So major intersections where there's traffic and people are going to be sitting looking bored, and it's just like a billboard. People look, and if somebody's in the process, maybe they just inherited a property or they're looking to sell, they're going to see that and they're going to call it and try to get a cash offer. So you have that strategy too. The best strategy that I like, because it's not like everything I just explained. What I just explained is you chasing people, and there's nothing wrong with chasing people. And some of these strategies are cheap. You can put out a bandit sign campaign for like a couple $100. Go and get some poster board and some zip ties and a marker, and you can like launch a campaign. But I like more of a focused model where I'm getting hot leads that I feel are unique that might not end up on these lists. So my question becomes, what if these leads aren't on these lists? What if it's just somebody who's in a different type of pain where they're just like, I'm getting old. I'm tired of these people. Like they just walk outside and it's like some kid is like eating a bag of chips and just balls it up and just throws it like in their lawn. And they're just like, yo, I can't stand this anymore. I'm out. There are a lot of people like that in that type of pain, and they just want to leave, and they want a cash offer. They want to get out quick, and they want to deal with somebody local, somebody who looks like them, talks like them, is from where they're from. They'd love to deal with another New Yorker, especially somebody who's focused on the community. So you can take that same concept of the bandit sign and get it a social media bandit sign, is what I would call it. So you would have that same we buy houses concept, only if somebody's scrolling down their Facebook or their Instagram or their Twitter feed, and it's like, hey, we buy houses. I'm a local investor, cash offer. And you can target people in these states, in certain zip codes, at certain ages. You can do certain targeting of people who are looking potentially to sell. And people will fill out information, a contact form, reach out to you. And now it's a different vibe. Guys, if you're tapped into the YouTube channel, definitely like, comment, subscribe, leave a comment, ask a question. It helps the algorithm. It's a different vibe when you do this because now the dynamic is a little different, right? Because they reached out to you. You're calling them back. So the setup is very strong, and you can come off as more of an expert. Like, hey, I work with people like you all the time. I'm from the community. I'm local. You can really get to know somebody and their pain points. Hey, what made you fill out the form? What type of offer are you looking for? And you don't have to feel like if they popped up on the list, right? If they popped up on the foreclosure list, everybody who knows this process is running that system, and they're getting blast texted and emailed and direct mailed from everybody because they're on this list. Now, if you just take that other approach and they reach out to you, they might not be on any list, and now they're reaching out to you. It's you may have way less competition and or no competition, so it puts you in a stronger position. So those are the ways. Those are the ways in terms of setting yourself up. You can do more of the labor intensive, or you can do the social media. Let the algorithm work for you. Put that algorithm to use, and that algorithm is strong. I mean, what's the evidence? A lot of you are here because the algorithm is strong. Because I put out, certain content and information out there, and it brought you, to a platform where you can learn more about real estate and kind of, do these calls or tap into the mentorship programs. So the algorithm is strong. And if you use it for wholesaling, you will get results. You will get results. So then you will have a bigger problem, which is, do you know what to say to a motivated seller? Because you're going to start getting leads right away, and motivated sellers are going to be calling you saying, "Hey, I want to sell my property. I heard something about this subject too. Is that something we could do? How can you structure this?" And you're going to have to know your information, like the info that we break down in the group course and in the VIP course, about creative financing. You're going to need to know that stuff, because you're going to be talking to 2 or 3 motivated sellers per day. So that becomes a second level issue. So hopefully that answers the question to its fullest. We got a question in the chat. What are the areas in the Midwest that Zillow and other investment firms are unloading these fire sale properties? Are there any metrics or tools to identify these areas? I would just Google this stuff, right? Because this stuff is it's like big news. Just track Opendoor. Google Opendoor. Opendoor loses $1 billion. Just Google that and read the articles, and they'll tell you exactly where they're unloading properties. I mean, a lot of it is some of your big markets, Arizona, like Phoenix, parts of Arizona, Boise, Idaho. They definitely made that push. Parts of Colorado, parts of Vegas. It's all out in kind of the Midwest. So all you have to do is read about the giants, read about Zillow, read about the areas that they were investing in that they lost money in, because everybody's kind of talking about it right now. A lot of us don't know this. I should have brought this up in kind of the market research. The CEO of BlackRock, the CEO of BlackRock is one of the largest, if not the largest, maybe residential real estate investment trusts. So the largest owner of residential properties, single family, in particular. He just dumped like 40 million of stock, of his own stock, just sold it. And he has a habit of selling before the stock kind of collapses to various degrees, before the stock goes down 10, 15, 20%. So he's been selling the company stock. Like, he's trying to get out before it falls further. And it's just showing the pain that these big real estate investment trusts are feeling. And it's because they're a little riskier than the average mom and pop investor. The average mom and pop will put these things on like a 30-year fixed. And even when the market falls, they're still cash flowing. These hedge funds mostly did annual renewable mortgages, and because they thought they could just handle it. And now that rates are up and they overbuilt these markets and rents are down and properties are sitting on the market, they're bleeding out. So they have to fire sell. So you can just read about, the giants. It won't take you long to uncover these markets. And they're there, and you just target them. I mean, you can YouTube some of this stuff, and it's like these prices are going down. I was watching one thing on a Zillow property. They price cut it. They bought something that they thought they could sell. I'll tell you guys their overall philosophy and why they lost. And I saw this coming a mile away. I had a business partner at the time who was like arguing with me. I'm like, this is a bad business model. And he's just like, I believe in these people. I believe in the founders. And I was just like, what does that mean? Like, you trust the founders? I get that, but the business model is fundamentally flawed. Their model was, we can go into Phoenix and buy a property at the top of the market from a seller. So somebody wants to sell their home, you could list your property with a realtor and sell it, or we could just give you the money in like 48 hours or 3 days or whatever. And they were paying people like, I'll buy your house for 700,000, and then they would hold it for a month, mark it up to 740,000, and sell it. And they're like, oh, well, we can just do this all day because the market's going up. And I would thought to myself, but what happens when the market pulls back? You can't do that. You're just gonna lose, but you're gonna lose at scale if this is your business model, because you're gonna have thousands of properties that you just overpaid for. And they're like, oh no, that'll never happen. We have a great group of analysts, and they run their calculations, and we have an algorithm, an algorithmic equation, and blah blah blah. And the market collapsed, and they lost billions of dollars. It is the bottom line, because the market started to pull back slightly. 10% pullback just buries these people. So I saw something with Zillow. They had a property they bought at the top of the market for like 790, and within 4 weeks it was marked down to like 580. But then you have to multiply that by 15,000 properties. That type of loss is billions of dollars just obliterated for no reason, just for greed, in my opinion. So you can track this data. You just have to Google it, read about where they invested, and just look at those areas, and you're gonna see the price drops. Like, it's obvious. You're just gonna see, if you set up deal alerts, it's just gonna say price drop, price drop, price drop. You're gonna keep getting emails, back on the market, back on the market, price drop, price drop. That's how I know when it's a buyer's market or a seller's market. It's a buyer's market when people get deals under contract, and I'm like, that's too expensive, and then 30 days later it's back on the market. Or it's back on the market, then they price drop. Or it just sits on the market, they keep price dropping, because nobody's buying it at those prices anymore. And it's the number one indicator that you're in a buyer's market, is when sellers can't sell at the price they want, or every time they go under contract, somebody backs out after the appraisal. They go under contract because they don't know what the property's worth, because they don't know how to think like an appraiser. Like I teach you guys who are in the VIP course, like how to think like an appraiser. Once you know how to think like an appraiser, and you know the cost of construction, you understand the value of properties. And it's like, nobody can make money off this. It's coming back on the market. It has to. Or somebody's going to lose money buying it, which maybe, a dummy's kind of born every day, right? So to some degree, that could happen. Somebody could buy that property, but the likelihood is that the person is going to get a low ball appraisal. The appraiser's going to come in, whack them over the head, and say, no, this isn't worth 580. This is worth 325. And they're going to be like, oh my goodness. They're going to back out of the deal and walk away. I even had somebody have a seller try to put a clause in saying, if the appraisal comes back low, you just have to come up with the difference in the money. So even the sellers know that the market is flat and their projections are bad. But once again, it goes back to what I was telling you guys. The sellers are basically, they got caught up in early 2022 and in late 2021 with these COVID. It was really COVID related, like, sellers market. It wasn't a sellers market in Philly before COVID. It was a complete buyer's market. And COVID made it a seller's market. And then they got carried away thinking, oh, prices are up 18% year over year. They're just going to keep going up. No, that's bubble territory. They're going to go up 3% per year on average, not 18. So they got caught up selling that dream that, oh, you could overpay me for it and then it'll be worth more later. It's not going to be worth more later. Now the sentiment is so low, the consumer sentiment, that nobody's buying that story. So they can't sell it. So the properties just sit on market until the seller wakes up and drops it, price cuts it into a range that is profitable for the average investor or developer, which we're seeing now. I'm seeing properties back on the market where you could just buy them, park 20% down, and cash flow, $500 a month, Section 8ing a property. And that's a good market to be in. And that's a good investment strategy for a lot of us. It's very, very low headache, very low stress to just park a little capital and build some cash flow. So, stick with the market, pay attention to these metrics. This video will be up once we end it. So definitely watch this again, because there's a lot of game in these statistics, but it's not all just data. It's really the thought process behind it and how to tie it together. That as you start to do that more and more, and then accompany it with these price drops and back on the markets and kind of what you're seeing, which you can just go into any market and look at the data and see, you'll get better at your research, and you'll start to see the opportunity and kind of what's going on. Any other questions out there? Feel free to hop off mute. Please keep the question short, because I have to repeat it to the YouTube audience. So if you ask it verbally, please keep it concise. Yes. Yeah. So you want me to break down the cost there? Okay. No, that's cool. So the question is about the two strategies we talked about on the wholesaling end, which is going and doing kind of more of the grunt work of you know list building, maybe driving for dollars. Some of these things you guys have heard about, and bandit signs, and then the alternate universe of leveraging the algorithm and social media and paid ads. So I have a really good resource that I only release to my masterclass people, my VIP people, typically, that can put together one of these paid ad campaigns for you for like peanuts. Like I'm pretty good at the tech, so I was gonna build it out myself. But when I saw what this guy was charging to put it together, I was like, man, that this would be so foolish. Like my time is like I can't even make any sense out of this. We're talking a few $100 to slap this thing together. In terms of the cost, let's talk about the cost on the labor intensive side, list building. You could create, hypothetically, if you were just getting started. Um, Most of these websites are about $50 to $100 a month. If you wanted to get like PropStream or something like that, or some equivalent, $50 to $100 a month, you want to budget in. You want to budget in the cost of skip tracing, which if you're doing it in bulk, if you're skip tracing thousands of records, you're probably paying 7 cents or so, 8 cents per record. If you're doing just like 100 or so, you're probably paying more, closer to like 15 to 20 cents per record. So that's a couple $100 there in terms of like skip tracing. The auto texter is probably going to run you, $100 a month or so. And then there's some other software. I would say even with that type of a campaign, you're probably looking at wanting to carve out, $600 a month or so. You might be able to, if you're just getting started, you can get on like a 30-day free trial and get a lot of this stuff done like for free. And the only thing you would be paying for really is like the skip tracing. But some of these platforms will give you like 1,000 free skip traces, like 1,000 records for free, because you're a new applicant. So you can get an operation off the ground for anywhere from a few hundred to like $600 on this grunt work side. If you were doing bandit signs exclusively, so this is not like list building. Driving for dollars, of course, you could do for free. Just go around, drive around. You're looking for properties that have mail in the door, or the grass is not cut, or there's violations and yellow, tags on the door, or something that is like, this property is in nobody's taking care of this thing. Nobody cares anymore. You can do that, build a list, skip trace it. That only costs you, like $100 or so, or a couple $100 to skip trace it. But then there's the time and the gas, right? Because you're driving around spending gas money, which is, it's extremely expensive right now. So you can factor that in depending on your location and how much driving you could do. You can also do virtual driving for dollars, which is where you're just going on Google Earth and looking for properties that, according to Google Earth, would fit that criteria, the same criteria you would be looking for from driving for dollars. And you can do that and then cut out, the gas and the time and the labor costs there. So you have that. And this is all within $200 to $600. You then have your bandit sign strategy, which is really there are different companies out there that will charge you based on how many posters you want, and you can come up with like a messaging on your poster or a design, and they'll just print out like 100 of them from a poster shop, and maybe at like 99 cents per poster. And then you have to get your zip ties and then go around and take the time to put them in locations. So a lot of that is scouting out really good locations and then taking the time to go post them. And then of course people cut them down. So it's like you're gonna get the block captains who they don't like your bandit sign on their block, and they're gonna cut them down, which is why you're putting up hundreds of these, and then kind of scattering them around, and you have to keep doing it because people are constantly ripping them down. Some of them stay up forever, and if you have any locations, a pro tip: if you have any locations where you've seen a bandit sign and it's been there for like months, you probably want to put your sign there, because if it's still up, it's probably good. Any sign that's up is good because it's just increasing exposure and potential for people to see it and call. So you probably want to put your sign somewhere close by. But that strategy, you're looking at, a few $100s, $200-300. You're gonna have to do it uh, for a duration of time because people are gonna keep cutting them down. So even if you had 100 up, maybe it goes down to 40 because 60 of them just got ripped out, and then you have to do another 60 and kind of keep finding spots. If you're in a place where people are, where it's illegal, then you might run into an issue. When I say illegal, I mean like you could get fined. Like you're not gonna, I don't want to say never, but you're typically not going to go to jail for posting a bandit sign. You would get, at a worst case, in most cases, fined by the city, and they would fine you per like infraction. So if they found a bandit sign, they might usually they'll just call you and threaten you, and say like you better stop and take these things down. And then if you don't, then they'll try to go further. But it's hard for them to track you down as well, especially if you have like a burner phone and like you're really playing the game hard. It's hard for them to know who to go after, and it could be under an LLC. There's a lot of that. So you have those costs, and those costs are in the 2 to 600. You could do a similar play, in my opinion, with the paid ad. So the paid ad is whatever you make it in a matter of a scale. So you could do, I would say you want to do at least $20 a day on a paid ad on social media. So if you were like, I'm gonna hit Facebook hard. I'm gonna hit Instagram feed hard. $20 a day, you can get some traction. You can get, some lead flow coming in, test the water. Maybe start off small. That's about a $600 a month budget. But that should generate you leads for like $5 a lead, right? So at $5 per lead, you're talking to people, qualified people to a degree, people who've qualified themselves and said, I want an offer, I'm motivated. And it's kind of, in my opinion, cheaper than the cost to get a qualified lead from some of the other methods, and it's less labor intensive. So you have to factor in the value of your time to skip trace, to list build, to auto text, and to learn all this different these softwares and all these things, versus just set up something where people just fill out some information and they're like, call me, and you just pick up the phone. Hey, Miss Jones, I got your application. It says you're interested in a cash offer. I'm a local cash investor, kind of from the area, and I want to make you an offer here and see what we could do. You can be on the phone with somebody in days, like in a matter of days of setting up your campaign, and it's just much more direct. So I think it's a more qualified lead. So even if it was pound for pound, the $600 versus the $600, even if you talk to less people through the social media campaign, they'd be more qualified, and you're more likely to have less competition on those leads. They're more valuable to me in that sense. So from a scalability standpoint, I think the social media one is a little bit more scalable, because now I could, if this working, maybe I get one deal out of my first. Let's say I get one deal in the first 2 months. So I'm running this thing for 2 months, $600 a month, and I get one deal, and that one deal makes me 10 grand or 5 grand. Now I got all my money back plus a nice marketing budget and a little profit. Maybe I take 2 grand, put it in my pocket. Now I have another 2 grand I can bump into this marketing, and maybe I increase that spend to $30 a day. Now I'm at 900 a month, and I'm gonna increase my exposure, my lead flow. I'm talking to more people, and then I have a pipeline of people building up that were interested. They weren't ready, and I'm gonna contact them later. It becomes more of a thing where you can focus on building, in my opinion, building the business out and not chasing people around, but having people kind of chasing you. It's just a different, it's a different paradigm than chasing people around. So, 3 years ago, I wouldn't necessarily say that. Um, but now I would say it to a degree now, because so many people that end up on these lists are just getting blast texted and bombarded, because a lot of these websites like PropStream and Deal Machine and some of these others have been very popularized by the wholesaling gurus in the last 2 to 3 years throughout the pandemic. So I think the social media campaign is my recommendation for a lot of people because it's easier. It's not that you can't have massive success the other way and build massive lists and get activity, because you can do so much volume. Like, with if you're doing it with a labor intensive way, you're controlling the volume because you control the size of that list. You could have a $20,000 list and blast out 20,000 texts, and even if you get a 3% response rate, that's a lot of people. So you can control your volume. But with the other way, if you're just getting started, I think it's a great way to start kind of smaller and talk to qualified people and get your first couple deals going, get the money coming in, and then you can scale up your spend into it. So it's a different philosophy, but that's kind of the cost and more important, the philosophy behind the two. I can't say what's right for one person versus the other, but you guys know me. I'll teach you how to wholesale, creative financing, flip, buy and hold, and do all of it, because I believe that the market presents opportunities for all of it. And when the market steps up and presents that opportunity, you need to have the proper tools to shift, adjust, and make things happen. So you need to learn all of these strategies, which is why we teach you all of them. Even if I'm in love with one at the moment, maybe social media comes out with some type of wrinkle where, like, going after people who are motivated sellers is wrong and it's banned now because, like, some super, like, liberal person views it as wrong and they start protesting and getting people involved, and then it gets banned. And then you need the other strategies. Like, you need to know how to tap into other stuff. So most people would say all of the above, but I think if you're just on a tight budget, you're small, you're a little tentative, you don't like cold calling, like, you might have more hurdles there, whereas, like, that person reached out to you, so now you feel more comfortable calling them back, and it's a different conversation because they reached out. That's kind of the thought process behind that. So hopefully that helps. But those are the costs that you would want to think about, and then of course you could always scale all of these costs. So there's cost of both. Yes. Yes. Yeah. That's a good question. I got it. No, it's a good question. Yeah. So the question was, I don't want to use my own profile. Like, I don't want to have my face on it, like Brian Bry's houses, and then it's like my friends are there and they're like, yo, what are you doing? Um, so what do the question is, what do you do? How do you have to use your profile? How do you set this thing up? You want to create a business page. That's the best way to set up the ads anyway. You have to set up the business page typically to run these types of ads. So what you want to do is set up a business page. Doesn't take you long. Come up with some type of logo. You can go on a website like Canva and create a logo very cheaply, very efficiently, or go on Fiverr.com and just pay somebody, $20 to create a logo for you. Come up with a business name. One of mine was the Philly Home Buyers United. Just something that feels good, makes people feel good. Something that's local. If you're targeting like your backyard. If I'm in Atlanta, Atlanta home buyers, um, whatever, United, committed, committed Atlanta home buyers, whatever it is, and have your logo. You'll have a picture of yourself, or maybe if you have a partner, somebody, whoever's working there, and you can get a separate cell phone or separate number. There's a lot of apps you can tap into. Even if you have your cell phone, you can have an app that has another cell phone number. When that cell phone gets called, your phone rings. You can do stuff like that. So you have a separate number, business number, and then you're good to go. And it just has to pass what we would call like the sniff test. Because here's the thing: you don't have to be that special when you're offering people money. You don't have to be. When you're asking people for money, you gotta be special. You gotta like really roll out the carpet and like do all these different things. When you call somebody, you're like, "Yo, you want some money? You want some money for your house?" They're like, "Yeah." They don't necessarily care who you are to a degree. They want to make sure you're like real and you're not a scam. But you're not a scam. You're really there to try to negotiate a deal and get a property. So you're not doing anything unethical. But outside of it not being a scam and passing that sniff test, and a lot of that is going to be in how you communicate and your knowledge, which is why I'm so big with you guys on uh, if you don't know, getting mentorship, learning at a high level. And that's why I get nitty gritty in the weeds. It's not because it's like always fun, but even within the master class, especially when we're on this creative financing stuff, getting into the weeds of how transactions work, because people can ask you anything. And if they ask you something like, well, how does that title company work? How does that performance deed work again? And you have the right answer, and you're like, oh, it's kind of like this. It's kind of, if I don't pay, I don't perform, and then the deed goes back to you, and it's held in the title company. It's held in escrow, and it's already handled. So if I don't perform, and you see that payment's not made, the property goes back to you, and you're not at risk. And they're like, oh, I'm not at risk. Okay, I get it. And you can explain it to somebody comfortably, then you're gonna win deals. They're gonna pick up on the knowledge. It's visible through the phone, or the lack thereof is visible, and then creates red flags. So the focus is not necessarily on creating this masterful business page that is like bulletproof and sells people. They don't care. They're going to fill out the form. They want the call. The call is where the relationship is built, and people sell properties, and people sell and buy to and from people that they like. That's it. That's the difference between one realtor to another, or realtor versus you. Is I kind of like that person. I kind of like Brian. He seemed really relatable. He seemed kind of down to earth, and I might match how they talk. If they talk a little country, I might talk a little country. If they talk, like I'm gonna build that relationship and kind of get to know the person. But it's really at that level. It's really just building that rapport, and once you do that, you're gonna close the sale. Any other questions out there? Sure. Yeah. 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 Yeah, so the question was, sometimes I drive around and I see houses and they have these like red and white tag, signs on them. How do I evaluate them further? I mean, one, you can call the city. Usually there's like a 311 number or some type of number. You can call L&I. You can call the building division. You basically go up and read the number. They're going to leave a number on those tags that says this property needs to be addressed. The owner needs to call this number, or we're bulldozing it in 30 days. You can call that number. Hey, I was interested in purchasing this property, just doing my research. I just wanted to make sure, is this property on the demolition list? You start asking questions and inquiring, and they'll tell you, oh no, this property's got violations, the roof or loose bricks on the exterior. but it's just an indicator that there's something wrong with this property. Nobody is taking care of it. And you should, if you're driving around, like driving for dollars, you should put this on your list, skip trace them, call the person who owns it. And that might be the leading opener. Hey, hey, Mr. Smith, I see you have this property on 123 Main Street. I'm a local investor, and I was, driving by and just saw the make safe order on the door. I wanted to reach out. I'm not sure if you're interested in selling this property, but I'm definitely interested. I'm comfortable working with these types of deals. Would love to make you an offer. And you just build the relationship. You don't want to sell anybody anything or be pressy about buying their property or pushy. You just want to call and build relationships with people, nice and smooth, and you'll uncover, whether they want to sell or kind of, what their energy is. But a lot of people will sell. A lot of these kind of vacant and abandoned houses, they'll sell. They'll sell for pennies on the dollar. They don't care. Like, what? You'll give me 20 grand, sure. Because they don't even want to pay the property taxes. They don't want to deal with it. It's a headache. Most people don't know how to renovate properties. So yeah, I would just call and just dig. But call the city, call L&I, call license and inspection, call the building division, call the construction department, because they have all the info. And that's what I do. Like, if I buy a property that's got violations on it, that's what I'm doing. I'm calling L&I, I'm calling the building division. I want to speak to the inspector who issued the violation. And they're public officials, so you can get them on the phone. You can call in, get their email address, email them, and I just talk to them. Hey, so what's the problem? Well, the back walls collapsed, so you need to get an engineer out there and get it taken care of. And I have the resources to do that. So I'm like, all right, I'll get my engineer out there. We'll get the report in, and we'll take care of it. So you just do that research, but that research helps you to negotiate with the seller, as well, because they might not understand the severity of the issue. That could add some fuel to the fire. Any other questions out there? Looks like we're bumping up on about an hour. I'm good to keep cranking, but I'm not sure if there are any other questions out there. Sure. Yeah. 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 Yes. Yes. Well, yeah. So the question is, I mean, it's several part question. It's one is, can I target if I'm doing this paid ads campaign? We're retouching on that question. Can I do this in my backyard? Can I target like my backyard, which would be San Diego? So can I target a specific area, or should I broaden it? Is kind of the first level of the question, and then the second level of the question was, when I'm creating this campaign, I don't want to use my own profile. I want to use, a new business page that I'm creating. If I hired somebody on Fiverr to create graphics and or a website, could I tie in that website? So to address the first part of it, yes, you can target, a specific area, specific city. You can also then target interests or purchase behaviors. Like, you could target the keywords: foreclosure, pre-foreclosure, creative financing, um, sell my property, buying first home, you can target a lot of things with your ads. So you're going to target people who are looking to sell. There are also people on Fiverr who do keyword targeting for your social media ads. My guy, if my guy sets you up, he's going to set up the whole thing and the targeting. So all you have to do is pull out your credit card, put in $20 a day, and you'll start getting leads. It's really that easy, but it's not that easy if you're trying to go and do it yourself. So if you're trying to do it on Fiverr, you could kind of do all of that stuff. You can definitely keyword target and do even second level targeting in terms of age group. There's just all these different ways so that you're making sure your ads are getting in front of the right people. So you're doing some of that activity, and that is kind of all good. Um, if you pay somebody on Fiverr to create a website for you, you can have it so that they created this website and then you tie the website into the ads campaign. And when somebody clicks, I'm interested in a cash offer, boom, that click takes them to your website. And now they're on the website and they can fill out information on the website. And that's fine. There's also for things like Facebook, most of these social media platforms have it now. They have what's called like a lead form, where if somebody clicks on that ad, a form will just pop, right off of that ad, and they can just fill it out, and that has a higher conversion rate because they're not leaving it's especially for this thing. Like it's not like you're offering them like a free training or something like that. So this has a bit higher of a conversion rate when it's like, hey, I want a cash offer, boom, and they're right in it. You also have to think about this market, like the market that is online looking for cash offers. One, the market on Facebook is mostly older. So you're going to get a lot of people in their 60s that are filling out these ads. They're the ones, the baby boomers are the ones that own all these properties that are motivated to sell them because they want to move, they want to retire, they want to downsize. They have all these different needs, and they are going to be less technologically savvy. So when you start having them push buttons to go to websites to get off of Facebook, and you're doing too much to block from the direct conversion, where you just want a lead form, which means you need less, right? It's kind of good news. You need less. You don't really need a full website. You can get this done with a basic lead form and setup, which is something my guy would address anyway. So you can get it done pretty quickly. Yeah, short and sweet. Yeah, you don't want to complicate it. It's all it's a landing page. It's all about the phone call. Everything else is hogwash. It's just about getting on the phone, building a relationship. It's a go or it's a no go. Everything else is kind of in your way. So you don't want to overcomplicate this thing. It's really an impulse decision. Somebody is you're trying to be there at the right place, right time. And it's like somebody just, like I said, kids walking by, bag of potato chips, just balls it up, throws it on their lawn, and they're just like, I'm done. Today's the day. And then they go on Facebook to look at pictures of their grandkids, and they're like, oh, I can get a cash offer, in an as is condition. Check this out. So, and then you're talking and figuring it out, seeing if this is something they really want to do. Any any other questions out there? How do you get to how do you get to the money in what sense? Uh, so if you make an offer on a property, I mean, it depends on your exit strategy. So the question is like, how do you get to the money piece? Like if you make an offer on somebody's property, like a cash offer, and they're like, yeah, I'll do it. Typically, a wholesale model is to put that property under contract, take like $100, say, hey, here's $100. We're under a 90-day contract. We'll close in 90 days. And you make it an assignable contract that you could flip to another investor. If you don't have cash to close it, you could flip it to another investor. If there's enough equity in the property where you're getting this property for pennies on the dollar and you want to rehab it yourself and the numbers are good, go get a hard money lender. They'll fund it. They'll fund the acquisition and rehab, cash that person out, get them out of the way, give you the money to rehab the property, and then you can refinance out of it when you're done, pay off the hard money lender, and keep the property. Um, so it just depends on your exit strategy. If you're doing subject to, You could do a lease purchase exit, or like a rent to own exit, and just put down, a couple thousand to correct the subject to deal to get out of the pre foreclosure situation, and then go find a rent to owner, have them put down some money, to get you your money back out of the deal, and then they, enter the property, and they're the new effective rent to owner of that property. You're just collecting your money, not being a landlord, and at that point you would have no risk. You'd have no money in the deal anyway. So it just depends on your exit strategy, and that's stuff that I break down in our group course and in the VIP course. The different exit strategies out there. So it's a matter of, a lot of this is a matter of knowledge. We're talking about, with the marketing and all this, everything leading up to the call. Once you get on the call, it's knowledge. So how you get to the money is the knowledge of the actual, process, the deal structuring, the contracts, the negotiations, the flow, how deals close, how you can, kind of angle these deals. So it's really that knowledge piece, and tapping in there. So you can't skip out on the knowledge. You can make it less effort to get to the point of sale, but in order to really get that sale, you have to be knowledgeable enough to make somebody comfortable, and not comfortable in a malicious way, but comfortable in a real way. Like, you can answer their questions, you can answer objections before they ask them, and you can provide a good service that is going to solve their problem. So in a legitimate way. Yeah, having a mentor will save you. Somebody said having a mentor will save you thousands. Having a mentor, geez, I've lost over $500,000 in this game. Easy math. I've done over 300 full gut jobs. If I lost $1,500 per gut job, that's $500,000. And I've lost more than that, probably. I'm being conservative because I don't know. Maybe I don't know. Maybe it just feels better to only think I lost $500,000 and not more than that. But having a mentor, I mean, if you could get mentorship for a few $1,000s, and the school of hard knocks, going out and getting burned. I mean, the first gut job, like heavy gut job I did, I had a contractor run off with 40K. Mentorship doesn't cost 40K. Even if you try to get mentorship from Robert Kiyosaki, it shouldn't cost you 40K to go do like a mastermind and get some real mentorship. He probably tried to charge you like 30. But typical mentorship is worth every penny. You're not just paying for like a little bit of knowledge. You're paying for experience. You're paying for not being in a position to lose that much money, because those are the only two options. There's only two ways to learn: from somebody else who's lost the money and who can show you how to not do that. Like, don't do this, because if you touch this, you're gonna get burned. Or to go out and get burned. So I tell people all the time, there's only two things: there's knowledge and money. If you have all the knowledge of real estate that you need, you don't need any money, because you'll know so much in terms of deal structure that the lenders will just give you the money. You don't need it. Everybody will just show up with the bag. You don't need it. But if you have no knowledge, you need $1 million to just burn through. You burn through that million, you'll know what you're doing at the end of that, but you'll have a lot less money. But then you'll have the knowledge. What you really want is a little of both. I got a little bit of money, but I got mentorship, so now my knowledge is way up. And now you can be dangerous. You can be way more dangerous than somebody who even has a ton of money and no real mentorship or knowledge. So, I definitely recommend it. The only reason I didn't get good mentorship in that true aspect is because when I was looking, social media, it was over a decade ago. Social media was not built out like it is today. Even YouTube and all this stuff, I could only find somebody who was like, they were charging like $1,000 per phone call for 10, 30-minute phone calls. And they wanted 10 grand for 10, 30-minute phone calls. And I did a sample call, and I mean, they really had nothing to say. I don't even think they knew that much, quite frankly. And they just had a website. There was no material, no nothing to learn. It was like garbage. The flip side of it is there's so many fake people on social media. So there are gurus I know, because I know some of these people. They've done like 10 deals. And they're like, I'm a guru. And they have massive marketing, behind it. And there's a lot of fake people out here too that are just out, trying to grab money. And that's why I think it's important and why I keep some of these mastermind calls open so you guys can come and judge for yourself. You can judge and trust yourself to see real knowledge, and what makes sense for you, and that's what you should be doing, is trusting your what's right in front of you. Like, is somebody knowledgeable? Can you ask them questions? Can they answer them? And is there knowledge there, or is there not? And the proof is in the pudding, because people can't make that up. Most of these guys, you never talk to them. Like, if you join the course, you never talk to them one on one. They don't allow you to ask questions in an open format because they can't answer them, and they don't want to get embarrassed. They don't want to get put in that position where they're like, oh, I don't know. Like, they're not gonna come on and be like, yo, ask me anything about real estate. Go, because they could get humiliated. They don't know anything, or they just know one thing. They're like, ask me anything about Airbnb. I don't say that. You can ask me about Airbnb and I'll tell you, but you can ask me anything about real estate. So you just got to do your own research out here. There is fake stuff, but there are more resources out here today than I would say ever. So it's like you can find somebody who looks like you, talks like you, is from kind of where you're from, and can help you to build a lot easier now than you could over a decade ago. So there's less excuses, in my opinion, for not having mentorship and just going out and just getting burned out here. Don't be penny wise, pound foolish. The cost of hard knocks is 100x the cost of mentorship, not 2 or 3x. How long did it take you to stop losing a lot of money? It really took that. Yeah, I'll answer that question. Somebody asked, do I have any classes in person? I have my ride-alongs. If you guys want to do a ride-along, join me in Philly. I'll send out some information on that. I'm going to do another ride-along probably in a couple months. It's going to be limited, probably 10, 15 people. Last time we had people flying from all across the country, outside of the country even, to tap into this ride-along. Spend a day with me in Philly. We'll go inspect properties hands-on. You'll see construction projects, full gut renovation projects. We got some properties we're going to be blowing the roofs off of, just doing crazy stuff. So you get to see it and kind of feel it. Link in bio. There's always some link somewhere. There's a video on my YouTube channel, Brian Loves Cash Flow, that talks about the Philly Ride Along. So you can tap into that. You can always reach out to me through the links in bio and schedule a call, and we can talk about getting you tapped in. But I'll be sending out a text and some information on that for the ride along. Like I said, only 10, 15 spots. So if it's something you want to do it. But I'm not getting like a triple wide bus and everything. We're going to be on a small bus where there's a group where I can actually spend time with you guys and give you guys that full day's experience. So 10, 15 people, get in on this one. If you miss it, maybe I'll do more. We'll have to see. God willing, there will be more. The question was, when did I stop losing a lot? How long did it take for me to stop losing a lot of money? And I would say pretty much after that experience, like having that contractor run off with the money, that kind of woke me up, where it was like, I can't trust that to somebody. I can't trust somebody to handle the construction at that level. I have to have a system to manage the money. What I learned was contractors they're not money managers. Like, I'm an asset manager. I used to work at a high net worth firm that managed 1.3 billion for 300 families, 300 privately wealthy families. I'm a certified financial planner still. So like, I'm an asset manager, right? I know how to manage money, and I know about financial planning at a fairly high level. A contractor, just because they're good at building houses, does not mean they can manage money. So you shouldn't give them a ton of money or advance them money, assuming that they can manage it. Really, you're a better manager in most instances than a project or project manager or contractor. So you just want to constantly put yourself in a position to be in control of that money. Even if you're working with a GC, you want to pay everybody, pay them, pay the subs, and control the money, buy the materials direct, and keep learning. So as I took over and stopped working through GCs and kind of trying to shortcut that process, it's not that you can lose money differently, because like, as you take it over, you start to learn the cost of construction, and then you start to manage it like differently, and then you create efficiencies, and you get better. Because once again, I didn't have mentorship, so I'm like going through iterations and figuring out how to control this stuff. And then after a while, I'll say after about a year of just playing with it and, controlling that flow of labor and the cost and the materials and all of this stuff, I started to create the efficiencies around it to solve out enough problems to make it highly profitable. So it took time, but it doesn't have to take anybody on this call time with mentorship, because you can be given a direct path, which is just like do this, and you're straight to the money. So it's back to that question, like, how do I get to the money? Mentorship gets you to the money because it's just going to point you to the direct path. I already know all of these other ways that are going to lose you money. So then you just have to go straight to this one area, and it's like, do a house hack, save more money, do this, only buy this type of property, do this type of zoning conversion, work with this type of lender, create this level of a budget. You just start learning how to structure it. It's real estate also though is an investment, right? So with any investment, there's risk and reward. So you have to take some risk. There's always going to be risk with any investment in order for there to be a reward profile. They're both kind of interlinked. So you will always have the chance for loss, and things can go wrong. It's real estate. You could pull back a wall and it's like, yo, we got to blow this thing up. Like it's collapsing. And we didn't know that before. So that does happen. But even with that, long term, when you know what you're doing and you're doing the right strategy, even if one deal you lost 30K, the next deal will make 100,000, and now you're up 70, and it just kind of will keep flowing. So if you're doing like 10 deals, you're usually going to be in North Philly. They have the diversion program for like, you mean for like evictions? Um, Sorry, I just muted you. How long do I think that's going to be in effect? The Philly diversion program. I mean, it could be in effect. I don't know. I mean, they could keep it indefinitely. Philly is a very blue city. It's in a state that is very blue, but the city is definitely blue. Um, which means, it's heavily Democratic leaning. It's very liberal. It could be in effect for a very long time. Um, and it's not that the diversion program is horrendous. It just means you have to step up your underwriting standards. You have to step up your underwriting, and I talk a lot about that in the course. In the VIP mentorship course, I talk a ton about underwriting and screening tenants. We have entire sections of the course that are just focused on how do I underwrite, how do I deal with Section 8, what are the tips and tricks, how do I like pick good people? Because this whole business is about picking good people. If you did nothing else but buy properties well and put good tenants in, you'd be successful for the rest of your life. You wouldn't work a 9 to 5 in 4 or 5 years ever again, because you put good tenants in, you made cash flow, and that is a core skill set. So you don't want to necessarily worry about that stuff and the prevention programs. You want to worry about just never being in that position and not dealing with what we call professional tenants. Professional tenants are tenants that know the landlord tenant law better than you, better than your attorney, and sometimes as well as the judge, because they filed every appeal, every motion. They've been running for their whole life, and they know every game. And there's a way to screen for that most people don't know about, and you just want to stay tapped into. So it's a matter of knowledge. It's a knowledge base. Like, you can skip out on that, and then you won't be as concerned with it. I mean, most people don't know Section 8 tenants in Philly. If you get evicted and you're on Section 8, they kick you out of the Section 8 program. So as a Section 8 tenant, you would be more afraid of an eviction than a regular market tenant. A lot of people don't know that. So you can leverage even that little bit of knowledge to your advantage, right? If you know that, you can inform a tenant like, look, we don't play around here. If you're the type to not pay, you don't want to come here because, you don't want to risk XYZ. And that will, believe it or not, ward off somebody who likes to play games. Just comments and posturing before you move somebody in can protect you. But there's like levels to this game. There's even more than that. People are more than their credit score and even their eviction history to a degree. They're more than that. But they are their eviction history if they're a professional tenant and they file appeals. What do I mean by that? You could have two tenants, both have been evicted. They have eviction history. But I look into the actual court record. Like, I don't just see they've been evicted. Okay, check or minus. I actually click in the court records. I go into the city records and I read the case. When they got this judgment against them, did they appeal it? Did they appeal it twice? Did they try to push back even though they had no case? Did they delay every time? Or did they just get foreclosed on? Somebody who just gets foreclosed on, didn't even fight it and stuff, they're not, they might have just come on hard times. They're not really a professional. Somebody who's filed like 3 appeals in the same case and stayed an extra 120 days just to be, annoying and frustrate the process, that's somebody where I'm like, I gotta watch out for this person. So there's levels to it. But who knows? The eviction prevention program could be here to stay. I don't know. It might be. I'm not necessarily against it because a lot of people, the goal of that is to put people on a payment plan and try to get them caught back up. And a lot of people, only 40% of evictions go through. Most people will either pay and recover or leave. Only 40% of people stick around to the point where the sheriff shows up and it's like, get out. You got 15 minutes to grab your stuff. So most evictions don't happen. They don't go all the way through. So prevention programs here's the thing. Philly always had a mediation process. So even when you go to court, they ask you, they should try to streamline. Would you guys like to go to mediation? And they try to push you there. Like the judge tries to push you. Then you say yes. Typically this is like the best way to go. Yes, we'll go to mediation. And then you sit in a room, they have a mediator there, and you draft up a repayment plan, and both parties sign it in front of the mediator, and the mediator signs it. And it says you're gonna pay this on this date, this on this date, this on this date. And then if they violate the mediation plan, then it's just like a streamlined eviction. That's pretty much what the prevention program is they're just streamlining more in that area without even having the attempt to say, no, I don't want to mediate, I just want to push out. They're pretty much forcing the mediation, but they always encourage the mediation, and it's the right thing to do in terms of rapport with the judge, to be like, look, we tried the mediation, it didn't work, they didn't comply with it, so they're leaving us with no choice. So they've kind of always been like that in Philly, which is why I don't have a big problem with it. The mediation is the first step that you want to do. You just want to do it fast. You don't want to be, having somebody owe you 3 months rent and then you're finally getting around to it. You want to be on it like pretty quickly. So hopefully that helps. Any other questions out there? I think we'll do maybe 1 or 2 more and then we'll wrap it up. Going once. I think you guys are talked out. Mikey, yeah. Oh, to look up the class. Yeah, if you want to tap into, let me send out my link. If you guys want to learn more about the VIP masterclass, or kind of any of that stuff, I'm gonna copy this link and just drop it into the chat. Just book a call. Hop on a call. We'll talk, one-on-one about the masterclass, how you can get started in real estate, if this would be a good fit for you, if you'd be a good fit for us, if we'd be a good fit for you in terms of mentorship, the cost of the one-on-one mentorship, and how to get started, what the best strategy is. So yeah, if anybody's interested, just click that link. It'll take you to my calendar. Book some time on the calendar so we can talk. And stay tapped into the channels. Brian Loves Cash Flow on YouTube. You got the Instagram, Brian Grimes _247 CFU for the 24/7 Cash Flow University. You got TikTok at Grimes Estate, on TikTok at Grimes Estate. We got the LinkedIn. If you guys are on LinkedIn, Brian Grimes Real Estate. So just stay tapped in. All of that stuff backlinks here. So you guys want to stay tapped in. James, we need to talk about that boots on the ground too. We need to get you straight into that boots on the ground. And I didn't talk about that. I won't talk about it too much, but we got that boots on the ground program. If anybody's interested in that, where we build houses for you in Philly. So we help you to find the properties, lock them up for pennies on the dollar. We inspect them. We put together deal reports. Once we get them, we build them for you without the GC markups, just paying the cost of labor, materials, and then we help with the tenanting, property management long term. So you can invest in Philly from out of town, out of the country, by tapping into the boots on the ground program. So if anybody's interested in that, definitely reach out, and we'll talk about that. But that's it, guys. I'm gonna wrap it up. Yeah, I'm giving a lot of game. I'm wrapping it up, guys. So I appreciate you guys. Definitely stay tapped in to this channel. Watch this 2023 market update again, and we'll keep it moving, man. Appreciate you guys. If we don't talk before then, happy Merry Christmas, Happy New Year, and 2023 is here. It's enough 2023 talk. It's here. So stay tapped in. This window, it's like this, and then it's gonna be like this. So you gotta stick with it, and be ready to pull the trigger and get in a mentorship program. I don't care if it's mine. You should probably get in mine, because there's a lot of scam artists out there. But get into the mentorship program, and let's step this thing up and lock up these deals. Appreciate you guys. Talk soon.